This week, two official government data releases landed on the same day, and together they tell a story every retail property owner should understand. The U.S. Census Bureau reported retail sales slipped in January, and the Bureau of Labor Statistics reported the economy shed 92,000 jobs in February. At the same time, the University of Michigan's Consumer Sentiment Survey shows Americans have felt lousy about the economy for 7 months straight. But the full picture is more nuanced than any one headline. And if you own retail real estate, nuance is exactly where the money is. Welcome to the Retail Weekend Wrap-Up. I'm Ray Kang. I advise private owners of retail strip centers throughout Central and South Texas. And every week, we break down the data that affects the value of your investment. So let's get into it. Let's start with the Census Bureau's retail sales report, which dropped this past Thursday. January retail sales came in at $733.5 billion, down 0.2% from December. That's the first monthly decline since October 2025. Motor vehicle and parts dealers fell 0.9%. Gas stations dropped 2.9%. Clothing and accessory stores slid 1.7%. But here's what I want you to focus on. The Census Bureau also tracks what's called the control group. It strips out autos, gasoline, building materials, and food service. Economists use it as the cleanest read on underlying consumer demand. That number rose 0.3% in January, and on a year-over-year basis, total retail sales are up 3.2% from January of 2025. So the monthly print was soft, but the trend underneath is still positive. Winter weather also played a role. The Census Bureau itself noted seasonal disruptions contributed to the dip. This is a data point to watch, not panic over. Now, also on Friday, the Bureau of Labor Statistics released the February jobs report. Total non-farm payrolls fell by 92,000 positions. The unemployment rate ticked up to 4.4%. The BLS flagged something important right in the report. Employment in healthcare decreased, and they specifically cited strike activity as the cause. Healthcare had been adding an average of 36,000 jobs per month over the prior year, so that's a meaningful but temporary disruption. Employment in information and federal government continued a trend downward. Average hourly earnings rose 0.4% in February and are up 3.8% over the past year. Consumer price index is running around 2.4%. So in real terms, workers who have jobs are still seeing their wages beat inflation. The jobs number is a yellow flag, not a red one, but it is a number you should be watching because sustained softness in the labor market eventually shows up in retail traffic. The third point this week comes from the University of Michigan's monthly consumer sentiment survey, one of the oldest and most respected measures of how Americans feel about the economy, and it's been running since 1949. February's reading came in at 56.6, essentially unchanged from January's 56.4. The University of Michigan's own economist, Joanne Su, described it as sentiment stagnating. About 46% of survey respondents spontaneously mentioned that high prices are eroding their personal finances. That reading has been over 40% for 7 consecutive months. Here's what matters. The divergence in sentiment across income levels is stark. Higher income and wealthier stockholders feel meaningfully better about the economy. Lower and non-stockholder households do not. Joanne Su noted that sentiment for the wealthiest consumers is now more than 30% higher than sentiment for non-stockholders. For strip center owners, this income divergence translates directly into tenant performance. Retailers serving budget-conscious households face pressure. Retailers serving higher income consumers with a differentiated experience are holding up better. So these three authoritative data sources, the Census Bureau, BLS, and University of Michigan are all telling a consistent story. The consumer is under pressure but not broken. The divergence by income bracket is the real signal. Your tenant mix either captures the resilient spender or the squeezed one, and that distinction is shaping leasing demand and renewal risk right now in your centers. Now, let's shift to what's happening in the retail and restaurant space itself, because this is where the commercial real estate implications get very direct. Restaurant Business Online, the trade publication of record for the restaurant industry, reported this week that Pizza Hut is closing 250 US restaurants in the first half of 2026. This is part of a strategy Yum Brands is calling Hut Forward, which includes vibrant marketing, technology modernization, and franchise agreement revisions. Yum's CFO described it as a bridge to longer term acceleration of the brand. The underlying numbers tell the story. Pizza Hut's US same store sales declined 5% for the full year of 2025. System sales fell 7% year over year. And when a brand is closing 250 locations in 6 months, something structural has shifted. Continuing with restaurants, the National Restaurant Association, the industry's leading trade organization, published its 2026 State of the Restaurant Industry report, and it paints a clear picture of what operators are actually dealing with. Total restaurant sales are projected to reach $1.55 trillion in 2026, with real inflation adjusted growth of just 1.3%. The NRA's own language is telling measured growth. Operators are dealing with uneven traffic and elevated operating expenses. More than 9 in 10 operators cite food, labor, insurance, energy, and processing fees as significant challenges. And consumers, particularly lower and middle income households, are increasingly stretched. For real estate, this matters. The National Restaurant Association notes that more than 7 in 10 consumers say they would visit restaurants more frequently if they had more disposable income. The demand is there. The problem is the budget pressure on the households most restaurants serve. That's the structural tension driving the closure wave. The NRA's chief economist described the environment plainly. Quote, comfort and value are the twin pillars shaping America's menus right now, unquote. That's not just a menu trend, it's a real estate footprint story. The brands that can't deliver comfort and value at a profitable unit level are the ones shedding locations. To note, the restaurant industry's own executives are signaling a structural reset, not a temporary dip. For strip center landlords, this means two things. Number one, casual dining and mid-tier QSR leases carry more renewal risk than they did 24 months ago. And number two, second generation restaurant space is becoming a legitimate repositioning opportunity. Medical, dental, beauty services, and specialty fitness operators are all actively absorbing these boxes in our Texas markets. So here's what the data is telling us this week and what it means for your portfolio. 3 takeaways. Number one, the consumer is slowing, not collapsing. The Census Bureau's control group measure held positive. Year over year, retail sales are up 3.2%. Wages are still beating inflation. The soft monthly print was real, but it's one data point in a still positive trend. Number two, sentiment is divided by income, and that division maps directly onto your tenant risk. University of Michigan data is showing a 30-point sentiment gap between the wealthiest and least wealthy consumers. If your center serves budget-constrained households and carries casual dining or mid-tier retail, the gap is a risk factor in your next lease negotiation. And number three, the restaurant industry is telling you directly that 2026 will be choppy. Their own executives are saying it. The brands closing locations are doing so strategically, but that space is still going to hit the market. Owners who identify the right repositioning tenants before that space goes dark are the ones who protect their NOI. And that's your retail weekend wrap up for the week of March 2nd, 2026. All the source links are in the description below. Every article I referenced is a primary source you can go read yourself. If you own retail property in Central or South Texas and want to talk about what any of this means for your specific situation, please feel free to reach out. I'm Ray Kang. We'll see you next week.